a lot of projects, they are at the time when they're decided upon for going forward, they're based on single point estimates, yeah? Being budgets, number, durations. And what we see each time over and over again is that these projects go over budget, over schedule. And so the question becomes, what is wrong? Why is this happening over and over again every time? And this is sort of a little bit what we call the decision paradox. Although that we have a lot of data and sophisticated tools to analyze those data, what we see each time is that 9 out of 10 projects have cost overruns. About 91% of the projects go over budget or schedule. Yeah? And so this happens year after year across countries, across different types of projects. That's what Professor Flifberg calls his iron law. Yeah? Over and over again, projects go over budget, over time, and don't realize the benefits that they promised to realize at the time when the decision was made. If he describes that very well in his book, How Big Things Get Done, where he analyzed over 16,000 projects in 20 different fields in a lot of countries, and where you can see that for the type of project, there is a mean cost overrun, and for all the projects that have a cost overrun, you see the percentage in the second column that has more than 50% overrun. And you also see in the last column what the average overrun is for those projects that have a cost overrun. So it's very huge. And that is due partly to the fact that only few projects have a sort of a modular approach where you can repeat things and where you can become control or are controlling the cost and the schedule more easily, like in solar farms or in wind farms, compared to nuclear power plants or Olympic games that have very fat tails, so very large cost overruns and schedule overruns. And the reason why that is happening is because there is something flawed in our decision-making process. Yeah? We think about businesses as being a chess game where everything is on the table that you can predict very well, even if different moves can be made. While in reality, business and life in general is more like a poker player, where there is a lot of uncertainty related to it. And the former poker player and current writer Annie Duke describes that very well in her best-selling book, Thinking in Bets, Making Smarter Decisions. And the question, what is a good decision, is typically we tend to judge the decision based on the outcome. If a 3-point throw here goes in, we think this was a smart play. If the 3-point throw misses, we think, well, that was a bad decision. We better had made a play going for the dunk or something. So we tend to judge the decision based on the outcome. That's the so-called outcome bias that we have. So in reality, we need a systematic framework for evaluating whether we're making good decisions, independent of the outcomes. And that is what we call the decision quality, which is based on sort of 6 steps that you have to go through. And you have to sort of start, that's described also in another book. It's a theory that's developed by Professor Ron Howard from Stanford university last decade already. Yeah, where you have to start with the frame. Yeah, are you solving the right problem? Like if you want increase revenue, do you decide for building a new plant, or maybe you can think about making partnerships? Yeah, so deciding about whether or not to build a plant is maybe not the good frame. Yeah, if you want to increase capacity and revenue, for instance. Secondly, you need to create alternatives, yeah, that are diverse and creative. Yeah, not just one or two. You need to have different options and evaluating different options. Do you have the sufficient information? And here comes uncertainty into play. You need to incorporate uncertainty into your decision-making process. Do you have the correct values or metrics? How are you going to evaluate what is important? And once you have that, you can sort of do the logic thinking and comparing the different alternatives and evaluate them based on the values that you have defined. And finally, you can go into a meeting, make a decision, but if you leave the meeting without an action plan to really implement that decision, you have not made a decision. So you need a commitment. Yeah, these are sort of the building stones for a high quality decision. Yeah, and of course, your decision is only as strong as the weakest link. Yeah, you can have perfect information, but if you're only considering one alternative, your decision quality is poor. Yeah, and you're not going to make a good decision. Yeah. So, but in that process, we are sort of getting biased by what we call the decision traps, by our cognitive and emotional biases. And we have a lot of them. I've listed here a few ones. I sort of also illustrated where they come into play within the decision quality framework. I'm going to cover a few ones, but I'm not going to go over all of them fast, right? One of the biases that we have is overconfidence, right? We tend to overestimate our capabilities. And if you ask executives to come up with 90% confident intervals for a number relating to a question, in reality, only 42% of the time, the answer that they give falls into, or the answer to the question falls into the 90% confidence interval that they indicate. Yeah. An illustration of that was the Deepwater Horizon disaster, where BP was overconfident about the deep water exploration and the potential measures that they had there for the safety precaution measures that they had. So another bias is, for instance, the anchoring bias. Yeah, we tend to rely disproportionately on the first information that we get in negotiations. That's typically once a number has been mentioned, you sort of start to fixate and move a little bit above or below that number, but you're sort of fixated on that number. And Lehman Brothers and the housing crisis in 2008, for instance, was due to the fact that Lehman Brothers was basing their valuation of all the assets that they had in portfolio on the previous years. And you had from 2002 to 2006, you had an increase in the housing prices. And so they were each time relying on the previous number, the previous year's house price, that sort of functioned as an anchor that distorted their decision making and that overvalued their portfolio, yeah, and that led to their bankruptcy. The confirmation bias is another one. Yeah, we tend to sort of try to look for information that confirms our initial beliefs, and we ignore contradictory information that comes along our path. Yeah, that is typically human. Yeah, the Terranos disaster for the blood testing in California is, for instance, an example of that bias. Yeah, like I said, we have a lot more of these biases. Yeah, we're too optimistic. I'm not going to cover all of them since we're already a little bit late. We try to focus on the most recent information that comes to mind when we need to make a judgment or a decision. Yeah? We don't like to change our course of actions. Yeah? Once we've made costs and we need to decide whether to go forward or not, we are sort of taking those costs into account, and that is biasing our judgment of whether or not we should keep on going forward. Yeah, the sunk cost fallacy, that's called, and of course the framing bias. In the digital camera was invented by an engineer from Kodak already in 1975. But what happened was that they framed it as, how is this potential new tool going to undermine our film business, instead of trying to frame it as, how can this new tool be a new venture and lead to more revenue? Yeah, they sort of framed it in a negative way compared to a positive way, and that's why they never explored the digital camera within Kodak lead, and they sort of missed that entire digital framework. And so if a project is framed in terms of gains, people become risk averse. If the same project is framed in terms of losses, people become risk seeking. Yeah? So it changes our behavior. Yeah? But it also depends a little bit on the odds. For instance, if you have two people that are suing one another for 10 million, yeah, and one has a high chance of winning, but he's offered 7.5 million to settle, the other one has a low chance of winning, but is offered a decent amount for settling, yeah, who is likely to settle? Well, in this case, it's likely that Lehman is probably going to settle above Salomon, yeah, because he is looking at what he might lose, although his chance is only 10%, but if he's not settling, he loses 7.5, yeah, most likely, yeah. And Salomon has only a small chance of winning, and so when he plays, he sort of or doesn't settle, he has only about 500,000 to win. Yeah, he's offered 750,000, but yet he chooses most likely to take on the gamble and not settle. Yeah, so we change our behavior, and that is all impacted by how we frame the decision that we have to make. Yeah, groupthink is another bias that we have. So there are a lot of biases that influence our decision making, and that is natural because through evolution, our brain has evolved, and there were different threats that we needed to take into account. And so Nobel Prize winner Daniel Kahneman says that in our brain, we typically have two systems. The first one is a fast one, and the second one is a slow one. You can see the first one as sort of our reptilian and mammalian brain. The second one is more our human reasoning brain. Yeah, and they have different characteristics. And so when we need to make a decision, our system one often takes over from system two, and that's why those biases come into play. Yeah, and in order to avoid that, yeah, we need tools to sort of make those biases explicit, yeah, so that we need to be aware of them when we make decisions, and we need to try to avoid them, yeah. And so ModelRisk is a tool that can help you in that process, yeah. And if we look at the decision quality framework, you will see that ModelRisk has most potential for being used in the information chain, what we call the chain, and the reasoning chain of our framework. Yeah? And I'll briefly discuss those two potentials here. Yeah. The first of all, of course, most decisions still are made on single point estimates. Yeah. And we tend to fixate on single numbers and say, okay, that's a good decision, let's go forward with it. Yeah. While it is, of course, better, as you all know, to include uncertainty, and the more precise, the better. Yeah. Instead of using one number, construction cost is 45 million, it is a little better to say, okay, it's going to be 45 million plus or minus 3 million. But what does that mean? Is that plus or minus 3 million your standard deviation? Is that your minimum or your maximum? Is the 45 million your mean or your most likely? So if you can specify and work with, with probability distributions, like the ones that are available in ModelRisk, that sort of forces you to explicitly define the type of uncertainty that you want to include in your model, or that a parameter that is characterizing the behavior of a parameter. Yeah. And of course, you all know that you can ask different questions if you work with experts to sort of come up with those 3 points if you work with 3-point elicitation technique. Yeah. One of the tools that you can use in ModelRisk is the overlay distribution feature that is available when you are selecting distributions. Yeah. And I've given here an example of the same endpoints, but using them in the first case as a minimum and a maximum, in the second case as the 5th percentile and the 95th percentile, and the third case in green, the 10th percentile and the 90th percentile. You see that that shifts the form of your distribution, of course. And so now you can use this when you're interacting with your experts. Is this what you mean? You know, sometimes they're not sure about mentioning what is the absolute minimum, what is the absolute maximum for your distribution. They don't know, you know, how long does it take you? Give me an absolute maximum to go every day from your home to your work, you know, but a lot of things can happen, you know, there can be accidents. So that I don't know. So even my way, I was coming back from India through Dubai, going through Belgium, and I thought it was going to have a flight of 10, 12 hours in total, you know, and I got stuck. So that, what is the maximum time that you can be stuck? I never expected it to be more than a week, last week. So that are things that sometimes maximums, extremes are difficult to define. So you can use percentiles, but then you can use the ModelRisk tool to demonstrate, okay, is that what that means, that your minimum is that much or your maximum is that much, you know? So that use ModelRisk more as a sort of a dialogue interface tool than just as a sort of a calculation tool that runs Monte Carlo simulations. Yeah? When you talk about which distribution to use, and the talk with Francois, there was a discussion about, is the type of the distribution more important than the correlation? Well, if you need to define which type of distribution do you use, sometimes you have knowledge about the parameter or the process. Like if we're looking at the energy production of a wind turbine, we know that wind speed at 100, 150 meters height is behaving like a Weibull distribution that is scientifically proven. So you can use a Weibull distribution to describe wind speed behavior, yeah, in your model. Sometimes you have information available. If you don't have information available, you can use the distribution fitting tool that is available in Vose Fit. If you're not familiar with that one, let's see if we can, yeah. You see my spreadsheet, I hope, right now. So if, yeah, okay, perfect. If you have a data set, yeah, you can go to the fit function here, and you can say distribution fit, yeah, and now you get, oops, a pop-up window that comes up my other screen. There it goes. Let me make this maybe larger so that you see this better. Okay, and you can say, well, let's add distributions to fit, you know, and you can select, let's go to the continuous ones. Let's just say, let's select all of them, right? Add those to our selection window, say, okay. And now it's calculating and seeing which distributions are fitting my data set the best, yeah. And then you can select here at the bottom left, you can say overlay, all right. And now let's see, is the distribution type really that important? Yeah, you can select the second one that you have different criterias that are evaluating which distribution fits best based on that criteria, your data. And you can see, does it really make a big difference if I go from, and you see that sometimes the probability of reaching your mode is a little bit less than in others. Yeah, if you go to, let's see here, we have a significant, maybe different form that goes way higher. Yeah, you can use visual ModelRisk as a visual tool to see, okay, is that really going to affect that much my my decision? Yeah, you can switch between the histogram or the cumulative histogram. You can also have probability views, the straight line where you have your data and your fit here, and the straight line is the perfect fit. Yeah, and you see sort of in what around what percentiles your fit deviates from your data set. Yeah, so you can use this tool, and then you can insert it to worksheet. Yeah, and you can say insert it to worksheet, and then I need to make this smaller again. Yeah, and let's see, where does this go? There it goes, and you can. Oh no, I missed it. Okay, sorry. Yeah, you can then have your distribution into your spreadsheet. Yeah, so let's switch back to our presentation. There you go. So if you do not have data, yeah, don't try to focus too much on getting the perfect fit. Yeah, often we see that the type of distribution is not impacting your decision that much. Yeah, but focus on what characteristics are essential. Yeah, are they bounded versus unbounded? What it is a symmetric parameter or a skewed one? Yeah, how is the behavior in my tail of my parameter? And see if you can come up with a distribution that sort of mirrors that behavior. Yeah. And here again, approximately right is better than to be precisely wrong. Yeah. And one other thing that you can do if you're not entirely sure is you can, let me switch back here to my model, and let's see here, I have a model here that, okay, where you can use the Vose sim table function, yeah, to compare different distributions. Yeah, so this is a small model where you do an NPV calculation based on the number of competitors that are entering the market, based on your initial market size, the growth of the market, and so on, and some prices for a small product. Yeah, and I have used here in sort of here it goes. uniform function for my initial market size, or I can use a PERT function. Yeah. Suppose that you're not sure, or that you want to assess, is this going to impact my decision? Well, you can sort of come up with a way of comparing those distributions by using the Vose sim table function. Let me just find it here. You can write it, of course, but I think it's under general simulations tool. I think it's a sim table there. Yeah, there it goes. Yeah, and now I say, well, this is here, values to be used. Here is my table. I'm going to use these values here. Yeah, close that. Okay, just one bracket, and say, okay, that's fine. Yeah, there is, let's see, okay. And so now what I've done here for my initial market size in year one, yeah, I have an if statement, yeah, and that if statement is, yeah, either if it's 1, I'm going to use the Vose uniform. If it's 2, I'm going to use the Vose PERT, yeah. And so if I'm now set in the settings, let's see if this goes there, settings. Now, each time my video feed is on, my cursor is sort of a little bit more sensitive. I'm not sure why. My mouse, let's say that we run 2 simulations in the settings, because you have 2 simulations and 1,000 each, and you start the simulation. No, I don't want that. Yeah, and so now it is running 1,000 simulation first with the uniform distribution, and then 1,000 simulations with a PERT distribution. Yeah, and then we are going to see if this doesn't last too long. It might take a little bit of time because my screen here, I see that's because of the video feed probably. Okay, okay, sorry, this is going to take a little bit of time, so I'm going to just stop this so that we don't lose too much time on that one. But sort of you get a similar figure as the one that I had in my presentation here, yeah. And now you can see, okay, suppose that you're deciding about the 80th percentile as your value metric, yeah. Well, in both cases, they are sort of the same. So it's not going to matter which distribution I'm using, yeah. In other cases, there might be a difference, yeah, it depends, but that is a way that you can do that. The key question is the distribution selection, the type of the distribution, is that impacting my final decision? If not, then don't put too much attention to the selection of the right distribution. Yeah. On the other hand, as was mentioned in the question after Francois' talk, correlations is something that is often overlooked, but that can have a much larger impact. Yeah, and if you include uncertainty into your model, you have to ask yourself the question: do those parameters behave in or impact another, or is there a relation between those or not? And if there are factors that impact your variables, then you should include correlations. Yeah, and again, you can make a comparison between non-correlated model and a correlated model. You can overlay the 2 distributions, which I've done here. Yeah, and then you can decide. But in this case, for instance, suppose that your decision criteria for going forward with this project is that you only accept a 10% loss for the NPV, so the P10 needs to be equal to 0. Yeah, you see that in both cases you're above. So then whether or not you include correlations, that is not going to make a difference. However, if your criteria just happens to be, you see that there is a difference with 11% in I don't remember which was the correlated. I think the 11 was the non-correlated and 14% the correlated. Yeah. Then there is going to be an impact on your decision. Yeah. So this way again, you can use ModelRisk to run your scenarios, overlay them, compare them, and see if correlations make an impact or not. Yeah. And if they do, you should be looking at how do I determine my correlation coefficients. If you have historical data, you can of course calculate it. If not, you can again use maybe some expert judgments, but keep the correlation coefficient simple, like strong 0.7, moderate 0.4, weak 0.0, and non-zero. Yeah. And if you don't have the experts available that can give you information on the types of correlations, then maybe run your model with different correlation scenarios and see what the sensitivity is towards the decision that you are going to make. So these are all, again, practical tools that can influence how you can use ModelRisk for the information part of your decision quality. Yeah? And we can go over for the reasoning part. Maybe I'm going to go a little bit faster here, because that's more things that I think you know if you are using ModelRisk already. Yeah. Be aware of how that you understand percentiles, that you can explain them to your decision makers what it means. Yeah. Francois has indicated how you can deal with contingencies, and typically, people are often using a P50 as a base estimate, a P70 to a P80 as a contingency that is project related, to cover known unknowns, and more sort of the P85 to P95 as a company-wide management reserve that is kept. Yeah. Focus on the risk metrics that drive your decisions. Yeah, the probability of loss. What is the value at risk? Yeah, the value at risk is nothing else than the corresponding percentile. Yeah, the VAR 5% is the P5. Yeah. Now, the value at risk is not necessarily giving you a lot of information except then just that point estimate. Yeah. What is more useful often is the conditional value at risk, which indicate the average loss that you would have in case that you are below that value at risk. Yeah. So if you look at it in this way, the value at risk here, that is the P5, for instance, yeah, and the conditional value at risk, that is sort of the average of everything, the average you can lose in the worst case scenario when you're below your P5. Yeah, so that are metrics that you can use for doing your reasoning about the different alternatives that you have, that you're considering. And again, here too, yeah, the tornado graphs or diagrams come in especially handy. They immediately show you which drivers you should focus on. And I think we can, I was going to show you a little bit tornado graphs, but given that we are a little bit behind schedule, I sort of skipped that a little bit. And but also go a little.
I was going to say it's okay for you to take your time. Gustavo can squeeze his a little bit. So yeah.
Okay.
Take your time.
Okay. Let me see if I can switch to my model here. Where is it? I sort of lost it somewhere. No. Okay. Let's see if I can open it this way. Okay. Do you want to disable it now? Yes. Okay, I was Excel. Oh, okay, I need to. Yeah, my Excel was still running in the background of that simulation that I did. So I might. Okay, here we go. But okay, my ModelRisk just shut it down. Let's see if I can reopen it and go to this one here for tornadoes. Just hold on, this should come on. I hope. Okay. That's still opening. It's a little bit slower. Okay. All right, let's see. Okay, then I should maybe, sorry, let me just, because now I have two Excels. Let me just see if I can use this one that has the ModelRisk. All right. Okay, let's see if I can increase a little bit. Okay, I have a simple model here where we have a few input. This is like a bioethanol production plant. We have an investment, and I've taken out a lot of uncertainties. I've only kept a few ones just to make it not too complicated. And where we're sort of running a 10-year forecast, and where we're calculating an internal rate and an NPV of that project, and where the factors here, that these ones, they are correlated and they are given here. This is what we've done using the ModelRisk. You see, if you go to this one here, let me show you. You see here, this is referring to the correlation matrix in Vose, and we've used here the correlation function, that is the multivariate cupola, by selecting those 5 variables and then correlating them with a correlation matrix that is specified here. So that is what is happening here. And let's see if I'm not sure if I can view my results or if I need to rerun it. No, I think probably need to. I had run it, but it's not. Let's see. Let me see if I can rerun this maybe just 100 times, just to make sure that it's not going to crash again. Let's see what is happening. It says it's preparing my simulation progress. There it goes. Yeah. Okay. Let's see if I can go my results. Oh, it's not showing my results somewhere. I'm not sure what's happening. Doesn't want to open my results window. Sometimes this happens when I'm on a video feed with, I'm not sure why. Okay. Never mind. Let's see if I can get back to my presentation. It's going to be a little bit easier. Oh, here. Okay, sorry for that. What I was saying here is that even go a little bit beyond the tornado graph itself. In ModelRisk, you have the availability to also look at scatter plots, and you can define targets. And you can say, like, oops, I think it's, you can say, what happens if my labor cost, in this case, I'm looking at a labor cost and my internal rate of return, right? Oops, I don't want that. Sorry. My computer is a little bit doing strange things. Labor cost and internal rate of return. What is the likelihood if I have a labor cost that is above 150 US dollars per ton, yeah, or it should not be in ton, US dollars per hour, yeah, and the likelihood that my internal rate of return is still going to be above 20%, because that's what your your target is, right? So then that becomes a visualization that you are in this quadrant, yeah, and the probability to be there is 28%. So this again, that helps you to improve your decision making and saying, okay, what happens if our labor costs rise, yeah, or if we can reduce them? What does that do to our internal rate of return or to our NPV? Yeah. So again, use the tools that are available in ModelRisk to reason about the decisions that you have to make and to compare the different alternatives that you are comparing. Yeah, you can even add scenario analysis if you want. Yeah, and you can also do that probabilistically, where you come up with a scenario that's more sort of a bull case. Yeah, where you say, well, market is going to grow, costs will be on budget, and we have fast absorption. Yeah, compared to a base case or a bear case, and say, what is the probability to be in the bull case? What's the probability to be in the bear case? And scenario planning, right? And see what is expected. And the same way to compare then your strategic alternatives that you have defined in the second step of your decision quality framework. Yeah, you now you have incorporated in all of them the uncertainty, you have done your reasoning, you have your metrics, and so now you can compare and see what is now the best option to choose. Yeah, and often that depends on the risk return profile and the appetite of your organization. Yeah, if you would make only an deterministic decision, you would say, well, the mean NPV is the highest in option A, so I go for option A. Yeah. Now you have an entire set of parameters that you can include and maybe look at the loss. Yeah. Option A gives you the highest return, but also a mean return. Yeah. But it's also giving you the highest risk for losing money. Yeah. So maybe it is better to choose option C, yeah, where the risk is smaller, yeah, if we don't want to get exposed to so much risk. So this helps you improve your decision making if you are applying your decision quality framework in combination with the tools that are available in ModelRisk. Yeah? And of course, ModelRisk can also help you in the other 4 steps of your DQ framework, but to a lesser extent. Yeah, maybe most of all in the last step about the commitment. Yeah, the visualization can help in creating transparency and alignment among all the stakeholders that you have and that you need to convince to go forward for your decision making. So this is a sort of a summary how that ModelRisk can integrate into the decision quality framework. And the key takeaways here are that decision quality requires a systematic uncertainty management, and that ModelRisk is helpful for that. Yeah. As far as your distributions, don't focus on the characteristics, not on the exact type of the distributions. Yeah. And similarly with correlations, try to incorporate them. And it's better to be approximately right than to be precisely wrong. And of course, think probabilistically all the way or the entire chain of your decision quality, so that you make better decisions in the end. If you apply this approach rigorously to all the decisions that you business-wise have to make, that will increase the probabilities of good outcomes in the long term if you do it that way. That's the advantage of applying this approach. Well, I hope, sorry for the interruptions and the difficulties with running the tool, but I hope that at least you sort of the points that I wanted to make, that they came across, and I'm happy to ask or to answer any questions if there are.
Peter, sorry, Gustavo.
No, go ahead, Dan. Yeah, there was one question I just wanted to, and then I will let you go with Peter, that came up like 15 minutes ago when you were talking about distribution selection, and it says, where do the data come from to come up with these curves? And I will leave it to you, Dan. Yeah.
Okay. Well, yeah, that depends a little bit if you have those available in your organization. Like, let's say, I'm more in the real estate and the environmental sector, and if you need to make a cost calculation for a new real estate development project, and you have done 10 previous projects where I don't know, 5 contractors bid each time for the global price for the constructions of those previous projects. That are all data that you have. So use those and see what on the based on the previous tenders that we did. Yeah, what was sort of the average bidding price, or the spread of the bidding prices that the different contractors came up with. Yeah, use those and then fit a distribution to it, put it into your new project model, and see how that uncertainty is going to affect your outcome, maybe the feasibility of your project. I hope that's a sort of an answer to the question.
Amazing, thank you, Peter. There is another comment here as well. An interesting discussion is also what the risk appetite of an organization would be in terms of VAR or ZVAR, to be compared with what metric: percentage of share capital, annual budget, total value of asset, or something else?
Well, you can apply sort of the VAR and the CVAR to all the different types of parameters that you have. But the question of the appetite is something that is, let's say, organization specific. It's the same as if we are investing in stocks, let's say, I might invest in more aggressively than you, depending on the risk appetite. Am I a risk taker, or am I more a sort of a risk conservative person? You may be the opposite of me, so you're going to invest differently than I am. And that applies to organizations and businesses as well. So you need to, if you want to use something like that, you need to have a discussion within your organization and see what is sort of the risk threshold, the risk appetite that we are willing to take on, and maybe for which type of projects there might be differences. Yeah, and then once you have defined that, then you can sort of apply those metrics, VAR, CVAR, to whatever financial or other parameters that you're using to base your decisions on. Is it NPV, or are you using internal rate of return as your decision metric, or both? Yeah. Well, you can apply then as well the VAR to the NPV as the VAR to the internal rate of return and see what you get. Yeah. Do you have to satisfy both to go forward with the decision, or is one sufficient? So that are sort of discussions that you need to have, and where I'm saying that in that sense, model risk becomes more a sort of a tool that is promoting discussion and clarifying what often we implicitly already think or know, but something like very likely is different for me than for you. How much is very likely? I may say maybe 75% is very likely. You may say very likely is 95%. So model risks help you to sort of make those implicit assumptions or reasoning behavior that we have, make that explicit and start a discussion within or among the team that needs to decide about whatever you are considering.
Thank you. We've got another one as well. In my organization, risk appetite is set in the way CF at risk, P50, and EBITDA at risk, P50, equals USD XX min, based on financial convents. Do you support this approach?
I should a little bit look into that, because if you word it that way, it's sort of difficult to think. But what is defined as being at risk? You know, that sort of is my first question. Let's see. I see here CF P50 and EB billion US XX million. The P50 is sort of I don't know. It's that means that you're making a decision based on the fact that in 50% of the cases it's going to be higher, or in 50% of the cases it's going to be lower. You know, so that is already quite a lot of risk, in my opinion. Yeah, but that's again a personal opinion that that you might take on. So I'm not sure if it may be the sort of typically the P50 is sort of considered as the base point, what you should strive towards. Yeah, but as far as decision making points, I think that you should build in contingencies, and then we're depending on if you're speaking about something positive or negative, you're more speaking about P70, P80, or P10, P20, or things like that. So yeah.
We have another one,
Yeah.
Peter. Yeah, go ahead, please, Dan.
What criteria should be considered when choosing a probability distribution?
Well, first of all, it depends a little bit on the information that you have available, right? Like Francois mentioned also that he's using a lot uniform distributions, which is perfectly fine if you know that your parameter or your variable cannot have a value below a certain threshold and cannot have another value above a certain threshold, and you do not have any information about the behavior of that parameter in between. Yeah, but often, like I said, there is sort of a stepwise approach that I'm not saying that is rigorous science, but that I apply, and that is first look at, do I know anything about the behavior of the variable that I want to define or describe with the distribution? Yeah, scientifically, in literature, theoretical behavior, like I was speaking about the wind speed for the wind turbine, that kind of thing. Yeah, do you know anything about that? If not, second, yeah, see if you can find data. Yeah, often there are more data available than you think there are, and even maybe you can look at variables that are very similar than the one that you are focusing on. Maybe that the behavior of those variables will also tell you something about maybe the behavior of your variable. Yeah, and see if you can, with the data, come up with a distribution that describes it. And then again, the fit is demonstrating which is the best fit, but often there is not so much big difference between the first one, the second one, or the third one that you choose if you're using a Vose fitting feature. Yeah, if you don't have data, the third thing is have a discussion with experts. Yeah, and see what do you think about the behavior. You know, not only the spread but the shape. Yeah, does it have a long tail? And like I say, focus on more on characteristics. Yeah, if you have a long tail, a log normal or a gamma function is probably going to describe that very well. And maybe there might be a difference if you're using the log normal or the gamma, but probably you have to run both and see if it impacts your decision. So there is no real list of criteria that says this and this and this need to be complied to have this perfect distribution for your parameter. Yeah, it's not exact science, but again, the most important part that you need to evaluate is the type of the function really that critical for the decision that I'm going to make? Yeah, and you can even take a few extreme functions and see is that impacting? Would I make a different decision if I'm using such an extreme function, yeah, compared to a more like a normal function? If that is the case, then it's maybe worthwhile to see, okay, we need to find more data or more information about how this parameter is behaving and how it can be described, because we need to be right, because the type of the function may have a big influence on our decision. But if it doesn't, then don't pay too much attention about the exact type of the distribution. That's my recommendation.
Amazing. Thank you, Peter.